Welcome back everyone to my channel. Thank you so much for being here. The US dollar is weakening today, ahead of key jobs data that will be released tomorrow. This is a very important event because this data will have a direct impact on the Fed's decision to either pause or to hike rates further. So what's going on? Let's go over the details. As you can see, we have three major currency pairs showing this move. USD JPY is up, so the dollar is weakening against the Japanese yen. USD CHF is up. The dollar is weakening against the Swiss franc. And USD CAD is also up. The dollar is weakening against the Canadian dollar. We're looking at just about half an hour until the opening bell on Wall Street, and all three indices are in the green. So if we take a look at the economic calendar, there is only one major event today. We have the initial weekly jobless claims that were released earlier today, and they came in better than expected. So does it mean that the Fed will not hike rates in June? Well, not necessarily. The reason I say that is because even though we have these better than expected jobless claims, we still have tomorrow's jobs report to consider, and this is the main event that everyone is focused on. It is possible that tomorrow's jobs report will come in weaker than expected, and if that happens, then the Fed will likely need to hike rates further in order to bring down inflation. In fact, if we take a look at the futures market, the odds of a rate hike in June are currently at 53%, and if we look out to July, the odds of a rate hike in July are 61%. So, the market is pricing in 2 more rate hikes this year. In addition to that, we have a rate cut currently priced out. The market is not expecting any rate cuts until November, and that is because the Fed's goal is to keep rates restrictive until inflation is brought back down to their 2% target. If we take a look at the latest CPI report for May, we can see that inflation is still too high. It's sitting at 8.4%, so the Fed needs to continue with their rate hikes. On top of that, we have the unemployment rate to consider. Right now, the unemployment rate is very low. It's at 3.7%. If the unemployment rate goes higher, that would be a sign that the labor market is starting to soften, which would be a positive sign for the Fed. However, if the unemployment rate stays low, that would be a sign that the labor market is still very strong, which would be a negative sign for the Fed. In other words, when it comes to the jobs report tomorrow, the Fed would like to see more job losses and higher unemployment numbers. That would be a sign that the labor market is starting to soften. Now, let's talk about the technical picture. We'll start with USD. If the dollar manages to close above this level, then it would be a bullish sign for USD JPY. But so far, we've been seeing some profit-taking. USD CHF is doing a bit better. The dollar is well above the 200-hour moving average. Now, the Swiss franc is considered to be a safe haven currency. So typically, when the dollar strengthens, USD CHF tends to rise. But in this case, the opposite is happening. The dollar is weakening and USD CHF is rising. So this is showing us that the euro is even weaker than the Swiss franc today. USD CAD is also doing pretty well. The dollar is well above the 200-hour moving average. Now, oil prices are rising today. Typically, when oil prices rise, CAD tends to strengthen because Canada is a major oil exporter. However, today, we're seeing the opposite. The dollar is strengthening and USD CAD is rising. Overall, the dollar index is also up today. The dollar is slightly above the 200-hour moving average. Looking at the bigger picture, we can see that the dollar has been consolidating since April. The question is, will we see a breakout this week? Well, it depends on tomorrow's jobs report. If the jobs report comes in weaker than expected, then the dollar may weaken further. But if the jobs report comes in stronger than expected, then the dollar may strengthen further. Thank you for watching. If you enjoyed this video, give it a like and consider sharing it. Subscribe to my channels and I will see you in my next one soon.